Welcome, folks, to Lesson 8 of the Swing Trading module. This is the $1 Million Swing Setup. Okay, folks, we're going to be looking at what I refer to as the $1 Million Swing Setup. Now, before we get into it, just understand that we are not stating that you're making $1 million on this. It just means that this is the best condition I have found in my technical tools that warrants, in my opinion, the greatest study and focus. And if we can get these types of scenarios from the marketplace, it just bodes well for us to seek out opportunities when they present themselves. The way I frame the $1 Million Swing Setup is in this order here. And it starts with obviously looking for a seasonal tendency. I believe wholeheartedly that there are strong seasonal tendencies in the marketplace that go without saying. I've shown many instances over the years how strong seasonal tendencies are. Because there's a strong probability of it continuing in the future, I start all my analysis there. There's a lot of trades that repeat themselves year to year where it would be foolish not to at least go in and investigate and see if there's any more technicals and fundamentals, if you want to say it that way, to come into agreement with that trade idea in alignment with a seasonal tendency, whether it be bullish or bearish. Now, once we arrive at a time there is a seasonal tendency, the next thing is we have to do a major market analysis. We break the market down in terms of the four major asset classes, and then we determine if we are in a risk on, risk off, and are we in a trending or consolidating market profile. Then we move to an intermarket analysis phase where we look at closely correlated pairs. We look at the relationships between the four major asset classes: stocks, bonds, or interest rates, commodities, and currencies. And then we do a top-down analysis, pulling out all of the major levels that would be salient for a swing trade. Then I go into and look for the trade setup itself. And then I go into, obviously, trade management. So we're going to break this down and give us a little bit more detail on how I go about going in and looking for swing trades. Okay, the very first thing is, this is going to be a mindset type teaching. It gives you the process, if you will, what I go through and how I think about things. So for a seasonal tendency, the first question I ask myself is there a seasonal tendency to buy presently, or will there be soon? If the answer to that question is yes, then I proceed to the major market analysis process. If the answer is no, then I consider another asset or market that does. If there's no asset class or market offering a seasonal tendency, then I wait for a new one. Now, what does that mean? That means there's no swing trades. I can not trade a swing trade unless the first rule is there has to be a seasonal tendency. Without a seasonal tendency, I don't trade it. Now, there's going to be lots of swings that occur every single year, every calendar month. There's going to be something. But if it doesn't line up with a seasonal tendency for me, I'm not taking it. Now, if you want to forget this portion of the template and you just want to simply look at everything else with the exception of a seasonal tendency being there, then go right ahead. But for me personally, what makes this $1 million setup is it's already based on historical evidence that it repeats itself many times, not just once in a while, consistently. Now, once I've been cleared for a seasonal tendency that is in the process of either forming or is currently in effect, I go to the major market analysis process. The question I ask myself, are the interest rate markets and or currency markets, basically the dollar index, trending? If the answer is yes, then I proceed to the commodity and stock filter process. If the answer is no, then I consider short-term or day trades for now, and I have to wait for swing trade conditions. Now, notice what I just stated there. Now, we haven't talked about short-term trading. We haven't talked about day trading yet. But what this does, it gives me a context to work from. If I don't have the conditions that are right for swing trading, I don't just simply say I can't trade anymore. I go down to the lower, shorter time frame, whether it be short-term trading or day trading. I just can't force the opinion of taking a swing trade without the framework? Are the commodity and or stock markets trending? If yes, then proceed to the intermarket analysis process. If no, then consider short-term or day trades for now and wait for swing trade conditions. I have to have both of these in agreement. Now, you only need one from each group. In other words, it can be the interest rates markets is trending and the stock market's trending, or it could be commodities and interest rates are trending, or it could be currencies and commodities are trending. But you need one from each group to agree that there's a trending environment. Okay, the intermarket analysis phase. This is for foreign currency or metal bullish swing trade setups. Okay, we look at the COT hedging program, and I ask myself, are commercials buying or selling currently? If they're buying, that means they're above the zero basis line that would be created by looking at the last 12 months. If they're buying, then we proceed to the correlation analysis process. If they're selling, then consider short-term or day trades for now. Wait for swing trading conditions. Now, let me rephrase this again. This is all the conditions for buying a metal or a foreign currency. Okay. What we're looking for is the commercials to be lessening their shorts. If they're below the zero line for the standard net trader position graph, if it's below that zero line, that indicates that they're net short. But just because they're net short doesn't mean that we can't use the information based on the last 12 months of range, what was the highest and the lowest range they've had in their net position. And dividing that in half, we can get a new range in terms of whether they're buying or selling based on their hedging program. If we can see that they have moved into a buying side, even below the zero level on the net trader's position chart, if this occurs, we can be moving forward to the correlation analysis process. Now, if we are above the zero line, then obviously the commercials are net long. But just be mindful that even with a net short position by the commercial traders, they can still be ferreted out in terms of what they're doing based on their hedging program in the last 12 months. If we don't see that, frame the buy by them being lessening of their shorts or new buying and a net long in the COT graph, if that's not there, we have to either consider short-term or day trades for now. In other words, we're waiting for swing trade conditions. The correlation analysis process. The question I ask myself is the dollar index supporting bearish price action for the US dollar? If yes, then I proceed to the commodity filter process. If no, then I consider short-term or day trades for now, and I wait for swing trade conditions. Reiterating this, if we're bullish on foreign currencies or a metal, we're going to be looking for the dollar index to be looking to trade lower, or it's indicating bearish prices are in order. In other words, it's SMT divergence against the metal or the foreign currency. If we can see that, then we can proceed to the commodity filter process. If we do not get that, we wait, or day trade or short-term trade. Commodity filter process. I ask myself, are commodities rallying higher, breaking old highs, or rejecting old lows? In other words, they're finding support and smashing through resistance levels. If we're seeing that, that bodes well for our filter. We're seeing commodities being bullish while the dollar index is bearish. That's a normal symmetrical market condition. If the answer to that question is yes, then we can proceed to the open interest filter process. If the answer is no, then we consider short-term or day trades for now, and we have to wait for swing trade conditions. Open interest filter process. Is open interest dropping, or has it dropped 10 to 15% or more? This indicates commercial short covering. You can get the open interest for a market on barchart.com, and I've done many examples of that, and I'll actually give all that in terms of the website addresses and all that in your PDF notes. If the answer is yes, then we proceed to the top-down analysis process. If the answer is no, then we consider short-term or day trades for now and wait for swing trade conditions. Intermarket analysis for foreign currencies and metal bearish swing trade setups. We look at the COT hedging program last 12 months for the net traders position on the commercial traders only. What's the highest range, high and low of their net positions? I ask myself, are commercial traders buying or selling currently? If the answer is selling, or if they're holding a net short position, then we proceed to the correlation analysis process. If it answers with buying by the commercials or the net long, then you have to consider short-term or day trades for now, wait for swing trade conditions. Correlation analysis process. I ask myself the question, is the dollar index supporting bullish price action for the US dollar? If the answer is yes, then I proceed to the commodity filter process. If no, then consider short-term or day trades for now, and then I wait for swing trade conditions. Commodity filter process. I ask myself, are commodities dropping lower? Are they breaking old lows? And are they rejecting old highs? If the answer is yes, then I proceed on to the open interest filter process. If the answer is no, then I consider short-term or day trades for now. I wait for swing trade conditions. Open interest filter process. Is open interest rising or has it increased 10 to 15% or more? This is commercial short selling. If the answer is yes, then proceed to the top-down analysis process. If the answer is no, then consider short-term or day trades for now. Wait for swing trading conditions. The top-down analysis process. You note the 9 to 18 month history of price action. You identify all PD arrays on monthly, weekly, daily, and 4-hour time frames, and transpose all to your 4-hour time frame chart. Note the IPTA data ranges on the daily chart that are 20, 40, and 60 days back from today. Look for PD arrays to assist in their identification. If all the IPTA data range PD arrays are exhausted or traded to for the 20-day look back, move out to the 40-day look back, then to the 60-day look back. Look for the IPTA data ranges and PD arrays to converge with one another to determine high probability institutional order flow and levels. Based on the bullish or bearish stance or premise you are trading, focus on the respective PD arrays for trade setups. For instance, if you're bullish, you're going to be focusing on monthly, weekly, daily discount arrays to frame a long entry. If bearish, you're focusing on the monthly, weekly, daily premium arrays to frame a short. The buy trade setup. You're going to note all monthly and weekly discount arrays. The best odds are seen with these levels offering an explosive rally. Confirm a monthly, weekly, daily discount array entry. This is going to be support for dollar index weakness for SMT divergence. If the dollar index confirms bearishness while trading at a discount array on your currency of trade or metal, execute trade entry. The trade entry. If buying a bullish breaker or mitigation block, the ideal entry technique is buying on a stop. If buying on a bullish liquidity void or fair value gap, ideal entry technique is buying on a stop. If buying on a bullish order block, rejection block, or below an old low, ideal entry technique is buying on a limit. Use position trading entry techniques for limit and stop orders. See January study notes pages 128 and 129 and 141 and 142. The sell trade setup. Note all monthly, weekly premium arrays. The best odds are seen in these levels, offering an explosive rally lower. Confirm a monthly, weekly, daily array entry at resistance with a dollar index strength for SMT divergence. If dollar index confirms bullishness while trading at the premium array on your currency or metal trade, execute trade entry. Trade entry. If shorting a bearish breaker or mitigation block, ideal entry technique is selling on a stop. If shorting a bearish liquidity void or fair value gap, ideal entry technique is selling on a stop. If shorting a bearish order block, rejection block, or above an old high, ideal entry technique is selling on a limit. Use position trading entry techniques for limit and or stop orders. See January study notes pages 128 and 129 and 141 and 142. Buy trade management. Look for contrary monthly, weekly, daily premium arrays to reach for while long. If applicable, look for fib extension confluences with premium arrays. Leave stop loss from initial placement until price has moved 1/3 of your intended trade direction. If trade moves in your favor 1/4 of your intended objective, take something off in profit. Use 20 to 30% for scaling first profit. Move protected stop loss to break even after first profit is taken, never before. When trade moves to 50% of your intended objective, look for new buying opportunities to add back the 1/4 taken off after a short-term decline. Take full position off at intended premium array objective or 75 to 80% and trail stop loss below the most recent 4-hour short-term low. Be mindful the market can and will likely make a run for sell stops at or just above 50% of the range you hold through. Don't rush trailing the stop loss. If you're stopped out, reconsider the original reasons for the trade. If they're still valid, re-enter at a new monthly, weekly, or daily discount array. Sell trade management. Look for contrary monthly, weekly, daily discount arrays to reach for while short. If applicable, look for fib extension confluences for discount arrays. Leave stop loss from initial placement until price has moved 1/3 of your intended trade direction. If trade moves in your favor 1/4 of your intended objective, take something off in profit. Use 20 to 30% for scaling first profit. Move protective stop loss to break even after first profit is taken, never before. When trade moves to 50% of your intended objective, look for new shorting opportunities to add back the 1/4 taken off after a short-term bounce. Take full position off at intended discount array objective or 75 to 80% and trail stop loss above the most recent 4-hour short-term high. Be mindful, the market can and will likely make a run for buy stops at or just below 50% of the range you hold through. Don't rush stop trailing. If stopped out, reconsider the original reasons for the trade. If still valid, re-enter at new monthly, weekly, daily premium array. Okay, the $1 million swing setup. We're going to be looking at gold for this example. The seasonal tendency we like to focus on, and we recently used in the mentorship. You can see through December into January, there's a strong tendency for gold to rally. And from January into February, again, we're using the calendar reference points at the bottom of the chart, not the top. The top yellow squares, rounded squares, they're the contract delivery months. What we're using is the calendar months at the bottom of the chart. So December to January, there's a strong tendency for the gold market to rally. And then continuing from January into February, the market generally for the gold market rallies. So we have a strong seasonal tendency for price of gold to rally from December into mid-February, early March. So I have a seasonal tendency, and we are checking our major market analysis. The bond markets are trending. The dollar index is trending. The CRB index is flat going into December. And the stock market is trending. So we have the market in a favorable condition for swing trading. Now we start looking at what the commercials are doing. The commercials, if we look back in the last 12 months, we can see that the range high made in January 2016, and we're looking at the red line, that's the commercials, and the low end of their 12-month range is here, and that's seen in the month of July. You can see as we went into the month of December 2016, the market shows the commercials going up in the green shaded area. And that's the range of the last 12 months. That's a buying condition. That means that they have hedged and bought aggressively and lessened their shorts. At the same time, the Williams percent R is in an oversold condition. That means sentiment is extremely bearish, while the commercials are showing a lessening of shorts and the open interest has declined. And here we can see the purple line, open interest, has declined aggressively, over 100 contracts. The commercials show a lessening of shorts with the red line going higher. At the same time, we are oversold sentiment-wise. Now we can start going in to see if there's justification for the dollar index confirming gold should go higher. You can see the midpoint of December going into January, gold was failing to make lower lows at a major support level for gold. And we'll look at that 1142 level. And the dollar index shows a willingness to go higher. So there's the divergence we're looking for. And we're going to go through the commodities, just a handful sampling. As we were going into December, November, December, January, soybeans was able to take out short-term highs. Every low was being rejected, so there was bullishness, undertones in the commodity market for soybeans. November, December, you can see that the high-grade copper has been bullish as well. It's not been wanting to go lower. Crude oil made a higher low going into December, and it was easily taking out short-term highs, rejecting the short-term low made in November. And live cattle was failing to make lower lows, easily taking out short-term highs. So commodities as a whole, they were bullish. And we're going to look at the 1142 level, which is the high noted on this monthly candle on the gold market. And you can see that's the bullish order block, the last down candle right before the up move in November of 2015. Rather large displacement going into 2016. Price trades all the way up into 1370 or so. And we refined our objective. Should we get long, we were going to look for that 1250 level, noted off of the weekly October 17, 2016 candle. And notice we have an old low back here as well. We're going to be referencing the 1200 level for gold, seen by May 1st, 2016, or May's candle, I should say it that way. Okay, so we have the 1200 level noted here. I want you to take a look at how price reacted there. We had basically the midway point of the price swing from the 1142 level. Now, we're not looking at the 1130 because you can never get the actual low. So don't think that you're ever going to do that. We're going to look at the monthly level order block at 111.42. So 111.42 is our objective or support level, and the range projection up is around 1255 to 1260. Midway point is that 1200 level. Measuring the range from the 1142 level off of that monthly order block, the PD array, and up to the weekly PD array, the premium of 1260, 1255, and the discount of 1142 to 1150, buying down at the 1145 to 1150 levels, projecting that range up and measuring that, we can get an equilibrium price point of 1200. Also note that from the equilibrium price point, there was only one real significant stop run, and it happened after the equilibrium price point had been breached to the upside. This is when you end up expecting a stop run on your trade. So it's important that you don't trail your stop loss up aggressively. You have to know your range, 1255, 1260. So we measure that in advance. So that gives us all the levels to start looking for and mapping out where each quadrant of the swing would be. We know equilibrium is at 1200. So between 1200 and 1145 or 1142, if you want to use the actual order block on the monthly chart. That range divided in half would give you a new equilibrium price point. And you can break that down and you actually start seeing the smaller price swings in the larger price swing because price is fractal. This is the intended trade objective, the full range. The equilibrium price point, when it's traded through on the upside, expect and anticipate a stop run to take out the sell stops below the marketplace. Then the second leg of the price action going to the final objective, 1255, 1260, that's usually not going to see another stop run until it gets to the last quarter or last third of the overall price move. From the midway point or the equilibrium, once that stop run was hit and all the sell stops were taken out below the 1195 to 1190 level, when price came down and hit that midway point around the 1183 level, it also came down into an order block, last down candle right for the up move, around the 1175 to 1180 price level, which causes that low. Now we have a daily PD array at that order block. We can measure this price swing here and start doing projections. So you take your Fibonacci, pull it from the high down to the low, and use your extensions 127 and 162. By having these levels on your chart, you arrive at 1260, which is at the confluence of Fibonacci and weekly PD arrays and monthly PD arrays. So it's this swing here you measure for swing projections. Notice also that this is the final portion of the range. So this second portion should only see another stop run after the high is taking out that's formed at the midway point of the overall price swing. So in other words, at the high of this price swing that's being noted here, around the 1220 level, once that high is taken out, you won't see another stop run on the lows until we trade through that level. So in other words, there's going to be a stop run after midway point is breached. Usually they come back and knock out the scared bulls that don't want to have any open risk. Then price trades through the equilibrium price point again, and then it makes another short-term high. When it comes back down, it will try to retest the midway or equilibrium high. In that retracement, many times you're going to see the stop run. That's usually the last one, and you can see that happening around that 1220 level. Then price rallies away. We called the 1220 to 1218, 1217 level as a buy, as a swing trade. It's moved from basically 1220 all the way up to 1260s. That's $4,000 per contract for silver. And you can see here, measuring that overall price swing again, you can see the swings and the grades at which, how they retraced. and breaking your overall price swing even on the second portion in a smaller quadrant. So you can see how fractals occur inside of the second portion of that swing. So what makes this the $1 million trade setup? The fact that we have a system by going through the overall market, breaking it down systematically, looking for conditions. If the conditions are there, we're given the permission to go to the next stage of analysis. If we do not get it, we have to sit on our hands and wait. Once we get it, we know we can go into the marketplace and trade accordingly. We know when we're going to take a stop loss and move it higher. We know when we're going to leave it alone. We know when we're going to buy on a stop or when we're going to buy on a limit. We know we're going to sell on a stop and we're going to sell on a limit. There's conditions there. Now, I know some of you, and it's going to be the ones that don't want to do the work and don't really want to pay attention, and you just want to give me a system where I can plug it in my chart and it's going to pop up something. That's not how this is, folks. It requires you to put some work into it. And that means while I'm talking, these notations that I'm giving you in audio commentary, you should be adding them to these charts. So in your study notes, it's not just my notes that you're looking for, it's you're adding your eureka moments or your questions about certain things. You add them. There's plenty of open space on these charts for that very reason. Otherwise, I would zoom in really tight and you wouldn't have much room at all. I want you to use the time and the study notes to make your own notes. Draw references to things that you didn't think about, or maybe you learned the first time in this teaching about something in regards to the stop loss, in regards to when are you buying on a stop and when are you selling on a limit. We have specific conditions. We know which PD array we look for in terms of buying on a stop and selling on a limit. All those, they're conditions now. You know when to do it, what price level you're going to look for. We're not looking at zones. We're looking at specific price levels. We're looking at anticipating when the swing is going to make a overall price move. We can divide that in half. Once it hits that halfway point, we will anticipate a stop run or a retracement or a bounce in a bear market. Once that rate's hit, the stops are gone. We're going to look for expansion going towards our larger objective. Once that equilibrium price point is taken out, we will look for another retracement, and then inside that, we will anticipate the second stop run. After that, generally, there isn't another stop run at all. It just makes a run quickly to the objective on the upside. So we can see that second stop run in here. Note it's after the midway point is breached and it's traded higher, and it comes back as a retracement. Then finally, that last portion is a quick reach for that 1260 level. I promise you, if you go through this and you take the consideration of going through every single detail and applying it to your charts and looking at examples, you'll see that what I'm explaining here ferrets out the really solid swings. Also note that it's also limiting your trades to only those that are seasonally poised to move higher or lower. So it reduces the number of potential setups, so you can't overtrade. It's literally impossible to overtrade. You know now, because of the content in January, what the seasonal tendencies are that I like to trade. There's nothing apart from them that I want to trade as a swing trade. Majority of my trades are short-term and day trades. That's why I excel there, because most of my trades are there. So if you keep doing a lot of the same thing, by experience, you get good at it. Swing trades, again, they only set up around 4 to 6 weeks. I can't wait 4 to 6 weeks to take a trade. I have to be doing something more frequent than that. So if you can't day trade or short-term trade, this is in my opinion, the $1 million answer to that question. What should you be doing? You have all the conditions in this marketplace now. I've given you the rules. It's clear cut. It's literally, you can make a flow chart of your own, or checklist, if you will. But the way I just did it here is exactly what I do. And you've watched me do it without going through this whole mechanics of it all. That's the process I went through to come to the conclusion that gold was going to go higher and silver was going to go higher. All of these things line up. But it's not going to be any benefit to you by you just watching the video one time and then waiting to get to the next thing, like there's going to be some secret little plug and play and it pops up in your chart. You have to think about some things and you have to make decisions. Each stage of your analysis, you have to question, is there something for me to do right now? If there isn't, It doesn't mean forget the whole idea. It just means you have to wait for new information. And that's the hardest part. That's where patience has to kick in. Either you're going to become patient or you're going to remain impatient, and you're not going to be a part of mentorship. You're not going to be a successful trader. You're just going to chase something else, or you'll forget trading altogether. The ones that are solid, the ones that are convicted about becoming successful in trading, they know now they have rule-based ideas for swing trading. You know that you got to do certain things to get to the next stage of analysis. Nothing in here is difficult. Nothing in here is highly technical, but it is a procedure that you go through that leads you to the outcome you're looking for. Don't take my word for it. Use the framework and go back over, say, the last 2 years and see if those ideas aren't ferreting out all the solid swing trades, both long and short. So it's been a pleasure for me to share this swing trading model of mine. And I pray that you do not make this stuff common knowledge. So again, if this is your last month with us, please be respectful and just know that you have something that's a really, really strong analysis concept. It ferrets out amazing swing trades. You've seen it has been used to outline gold market. This was the way I did it. Okay, this is how I did it. So if I tell you that's how I do it, just know that when we go forward and we break the markets down, because we've completed the swing trading model now, we will be able to go through the marketplace and actually do the real-time analysis to ferret out any new swing trades going forward as we go into the new content for short-term trading in March. So the concepts are this: as we learn all the rules about each individual discipline, the next month we can start going in and using it all. Now we have all of the framework for position trading and swing trading. We will be learning short-term trading. While we're going through the short-term trading in March, we will be continuously looking for swing trade ideas and potentially long-term position trading ideas. When we finish March and short-term trading is done, we will be going into day trading in April. While we're going through April, we will have all the information about short-term trading. In April, we will be absolutely trading one-shot, one-kills every single week. Okay, so that way you know what we're doing, how the context of the information is utilized, and all these things, how they come together. That's the framework. That's the structure. When we're done learning day trading in April, in May, we'll be day trading every single day while we learn scalping. And then we'll be going into other content later in the mentorship. So hopefully this has been insightful to you guys. I can't wait to get your feedback on what you think about the swing trading model. I told you it's not complicated at all, but it requires you to think. And you have to go through some of the content that you've already digested already, and you have to know some things. If you don't know what SMT divergence is, you got to do some study on that. And all that stuff is in the free tutorials. Until next time, I wish good luck and good trading.